Okay, let's start. I'm going to introduce myself and I will start the presentation and there will be the introduction. So please bear with me a second. I will actually share my screen so that we have everything in place. Here we go. Okay. Business exit mastery and the smart way to exit your business. That is the topic today we want to talk about. And just to dive in directly into the webinar. So this is our agenda for today. I give a little introduction and then we talk a little bit about statistics and go right after that into planning fundamentals or exit planning fundamentals, look at some exit options and also a business valuation. I will give you a case study so that you can see how exit planning is important for any business owner. Yeah. So what is best exit? So best exit focuses on business valuations. We do also, we call it business value acceleration, which means we work actively with business owners, shareholders to increase their value towards an exit, let's say maybe in 1 year, 2 years, 3 years, or even longer. We actually also plan or do exit planning and strategic planning with business owners. And if someone said, okay, we would like to exit in a year or even right away sometimes, we're also able to do an M&A, business brokerage and M&A. So this is a different entity, but that's what we do as well, right? So just about me, give you a little background, who I am. And so I'm actually, as you can tell, I'm German engineer by trade. I have a brand hands-on experience in many different industries, starts from electronic manufacturing. I was running a newspaper once. I worked in telecommunication and internet, in automotive, many different industries I have experience in. And I worked in C-level positions here in California, and I'm an M&A advisor for the last 7, 8 years. And I'm also a certified exit planning advisor, CPAR, certified M&A professional, and an M&A master intermediary. So it's a little bit about me. Of course, if you go on the website, you can a little bit read about more about me. So, but that's, I want to actually leave it with that. So let's dive into the presentation. So what are kind of statistics? What I'm using here is the Exit Planning Institute, which is based in Ohio. They do a survey every year in a different state and different area. And last year they did a state of the owner readiness survey in Colorado. This year they did it actually for Los Angeles, but it's not published yet. So these are the statistics I'm getting here from them. More, of course, I don't want to bore you with all of that, but if you're interested in that, I can definitely send it also to you. So when it comes to exit planning, that is, they call it, is not on the menu because they interviewed 400 businesses or business owners, and 65% indicated they have no formal or written transition plan. So, which is actually two-thirds of everything. So, and that is not only in Colorado. I've seen other surveys and reports that is all over the nation. And then the other third, the other 35%, they are asked the question, does transition plan include an updated valuation or evaluation overall? And they said 60% of those, they said no, there is no valuation. So they don't know what the business is worth. And of course, which of the following best represents the current understanding of the value? They're actually, if you look at the green area and the dark blue area, it's about 70%, 71%. They have not had a business formally valued, but have a good idea what it is worth. And I'm not sure what the business is worth. It's sometimes interesting when I talk to business owners, when I do valuations, many business owners think they have an idea about the business, but if it comes to pure numbers and the quality of earnings, etc., it shows a different picture. So, do you have a plan? So, do you have an exit plan? You can, answer it as of now myself, but let's start with fundamentals. So because you have to find a way where to start an exit plan. So as always, being prepared is always the best, I would say, medicine for everything. So developing an exit and succession plan, it's not just about value, but it's much more. And I will give you a little bit an idea what it is all about. So the three fundamental objectives that you should work on, what I suggested to work on, is first identifying personal goals. So what does it mean? So personal goals are like, what do you want to do after you exit the business, let's say? Or do you have any ideas, for example, in case of, let's say you don't want to exit the business now, but you don't want to exit, or you want to exit it later. So what do you really want to do? For example, I ask business owners, what is your plan when you sold the business, for example? And they say, okay, I want to travel. And I ask, okay, where do you want to go? They want to go to Europe for a while, but you can travel only so much, right? At some point, you're being back at home and then thinking, okay, what am I going to do now? So it is important to have an idea what you want to do. And the best way in identifying it and give you ideas about that is we at Best Exit, we help business owners to identifying these goals, but most of them is if you have a financial planner, an FP, he will work with you and identifying all the personal goals. But because when you're ready and know what you want to do after an exit, then that'll be a really, really smooth exit, and you will not regret anything later on. The second one is identifying the personal financial resources. For example, I had a business owner. He said he wants to open kind of a school to help other young students if they want to start their own business. And so he had some really great ideas. And we were looking, how much do you need your financial resources to just do this, but also being able to support yourself for the next 20, 30, or 40 years. And the financial planner, he can really help you to develop scenarios in what do you want to do and how much and what are the financial resources looks like that you need in the future. And then here where Best Exit comes into the game, identifying business resources. And I'll go into that a little later because it all actually plays all together in one strategic planning. So as I mentioned, personal readiness is important. So here are some ideas what business owners want to do is the same Exo Planning Institute. They ask them, some want to actually invest in another business. Some want to become a consultant. Philanthropy, they want to use their money to actually help others buy another business. Some want to just retire, most of them, 41%, and some of them have no plans at all. But the business owners must have personal goals and financial goals. That's what I mentioned before. So when it comes to, you know what you want to do, you want to be a philanthropist, or you want to invest in another business, or you just want to retire, what are the exit options? There are not only one exit options, there are more of them. And so, and as you can see, I like this picture because there's this little guy here, and the EPI, within this survey, they ask business owners what they want to do. For example, you can actually transfer your business internally, either to family members, son-in-law, or whoever it is. So this is actually 21%, is a significant amount. You can also transfer the business internally to a manager, a management team. I had a gentleman here who said, I don't want to actually sell my business or transfer my business to the big guys. I would like to continue, or I would like my managers to continue the business. So that is also an option. Internally, if you have a partner or you have partners, business partners who work together for I don't know how many years, you can actually sell your part to your business partner. Here is one strong recommendation is, if you don't have that in place, and if you have partner or partners, you should have a buy-sell agreement, which actually outlines exactly what happened if someone wants to sell the business or something disastrous happened, right? Then we have, of course, looking into internally transfer to all the employees, for example. And there are many different ways, which has a good tax benefit for the business owner, but it's not an easy process. So then we come to an external part, so we can sell it, and that's what we actually always preparing business owners for, and we're helping them through the whole process, selling it to a third party, for example, a financial buyer or a strategic buyer who is another company, for example, that want to close a gap. Let's say they are actually operating on the East Coast, and they want to actually come into California. So they buy companies here so that they have a footprint here. And then we have PACs, private equity groups. They also invest a big amount of money in acquiring companies. And as you can see, it's actually a third of the whole that is going to happen. Then we have externally recap, which is more like a recapitalization. An investor comes, invests 60% or the majority, and you still, as the owner, stays on for another 2, 3, 4, whatever years, and then you might get paid off or paid out later on. So, and then we have what is not always recommended is an external, as an orderly liquidation. You just sell your assets, your machines, or whatever you have. But that is where you don't get, let's say, a price what you might expect. Others, I call it more like an IPO. And then, of course, there are 2%. They're not sure which way they want to go. Oh, no, it's actually 32%. They don't know what exit options they have. So it is the first step to see, okay, which way I want to go, right? To really come up with the right strategy. So then we come into the business. Is the business ready And in this case, I give you a case study how to prepare your business for an exit and selling it to an external group, individual, whoever it is, or company, and how does it work? So the first step is to determine the business value. What is your business worth in nowadays market or on the market? So and there are actually three major aspects to look at. One is the revenue. Is it a company that makes $1 million in revenue? Is it a company that has a sales of 5 to 10 million? Is it a company that makes 50 million or 100 million or even more? That determines who might be interested in buying your business. If it is, let's say, $1 million company, most likely, or $2 million company, most likely, a financial buyer, an individual, is interested in buying the business, not so much a big corporation. If you are a company that make 20 million, 30 million, even more, then a bigger company is interested in buying the business because they're looking for larger organizations. The next step is, or the next biggest factor is, how profitable is your business? They look at the bottom line, they look at the performance, the business. Of course, that actually also determines the value of your business. And then we have a third one, which is the risk. And the risk is not always so easy and obvious to value, but there is a way in doing it, and I will show you, and I will get into all of these a little bit so that you have an idea what determines the value of a business. So of course, there are many valuation approaches. What we're actually looking at is we're looking at market value based transaction analysis, looking at comparables, how other companies in the same industry, in the same size, in that area are sold in the past. And we're looking at multiple of, we call it SDE, which stands for Seller's Discretionary Earnings, which is not the income only, but is a little bit higher than what you see on your profit and loss. And then, of course, everybody knows EBITDA, earnings before interest, taxes, depreciation, and amortization. But here again, we're using an adjusted EBITDA, which is most of the time higher than what you see in your income statements. And then we use also an intrinsic value using discounted cash flow, which actually uses future cash flows to determine the value of your business. And as I say, valuation is not a science, although it uses mathematics or modeling based on mathematics, but it is still an art, right? So there's always a range of value, and at the end, the market determines the price and the value of the business. So the first step in really getting to the value of the business is the quality of earnings. As we say, we adjusting the income statements. So how are we doing that? For example, if this is a smaller company, if you have a net income as per tax returns or financial statements of, let's say, $200,000 this year. So this is the bottom line, what you see in your P&L or your income statements. So we look at the business in a different way. We say, okay, there is the business owner's salary, or maybe they have more than one business owner's salary included in your general expense categories. So let's say you pay yourself as a business owner $400,000 a year as a salary. The next one is we look at personal expenses that are went through the business. You have, let's say, your daughter's cell phone you pay for it, but it's not a business expense, but you still pay it through the business because it is on your plan, or you have your own telephone bill at home that also goes through the business. So we actually, in this case, we adding all these expenses back, because if you're not in the company and the operation anymore, these expenses you have to pay by yourself, and the business is not paying for that anymore. That's actually the reason for that. The same with auto expenses. I have seen that some business owners, they have a big old-timer collection. So they maintain it, they have repairs, they pay DMV, they pay insurance for all of that. So if the company does not pay it anymore later after an exit, we will have to add that back as well. And then we have owners' retirement. Sometimes owners, they have a profit sharing plan, they have a 401k plan, the company pays for it. And every owner retirement plan does not reduce the value of the business, even if it is an expense. It actually increases or not affects the value as well at all. So we're adding back $150,000 that the owner pays into these plans. We're adding that back as well. Sometimes the owner has personal travel, goes to on Bahamas or to Hawaii, stays in a nice hotel for 2 weeks, and we add that back as well. Personal insurance, sure. Health insurance, disability insurance, only of the owner, not the employees, we're adding back as well. Payments to associated personnel, which means that your son works during the vacation time and you pay him a salary, let's say, per month, right? Or maybe more of them, $15,000, we adding back as well. Plus one-off payments. This is kind of a one-time expense. Let's say you actually use an attorney for certain things, and it is a one-time expense, we add that back too. But we also have negative add-backs. Let's say a normal salary for you as the owner, as a COO, would not be 400,000, it would be 200,000. So you have to pay a CEO who comes in later a $200,000 market salary. So we're adding that as a negative add back, right? That's why I have $200,000 negative, because you pay yourself a year-end bonus of $200,000, what you not would pay a regular CEO. And then we might have, not in this case, another negative add back, which is the rent. You own the premises, or you own a real estate, and you don't pay yourself a rent, or maybe less. So it needs to be adjusted to the market rent. In this case, we don't have it. I just want to mention that. So we have total add backs of $430,000 plus the $200,000. So we have an EBITDA of $630,000 per year in this year. And that's actually what we use as an adjusted EBITDA in this case, right? So the next one is we look at the risk analysis. The lower the risk, the higher the valuation, and vice versa. So that's the main concept behind that. So, and we at Best Exit, we're using 8 drivers that determines the risk of a company. And there's some other assessments as well. But we're using the financial performance. Okay, is your company profitable? How big is the company revenue-wise, etc. We use a monopoly control. Monopoly control means how big is your market share? Is there market share in your area? You have a market share in your county or state, or let's say LA metro area, or do you have a market share in the US and even in the world sometimes? That also comes into effect here. a Switzerland structure. It's a nice word. It actually relates more to how dependent you are to your vendors or suppliers, how dependent you are with your customer. For example, if you have one customer only who makes 60% of your revenue, which is very depends on this customer, if he goes away, the business and the revenue will go away 60%, which will be a big risk for a buyer. So he will not pay a premium for the company. So we have to look at that. And it also, the third one is how dependent are you on your employees? Do you have employees that are, some people that are engineers, they only know how to make certain parts, for example, and you don't know, and the other employees doesn't know it either. So that's also important here. The valuation, teeter-totter, it's a funny name. So that actually relates to a gross profit. It relates to cash flow. It relates to cash in the bank, which means actually how much does a buyer has to invest or in cash into your company when he buys it. The bigger it is, the less the value. The less cash he has to inject into the business, the bigger the value would be, right? Recurring revenue it's a really interesting aspect always in buying and selling a business. Recurring revenue, companies love recurring revenue. What does it mean? Revenue comes in, you have a subscription-based business model, so you don't have to go out and sell them all the time because you have a subscription, you pay every month or every quarter or whatever it is. Maybe not 100%. And there are 6 different ideas and models behind recurring revenue, the way you can actually design your business and design your business model. So the more recurring revenue you have, the higher the value. If you have returning revenue, which is more like you have a customer who is very loyal, who comes back all the time, this is returning, but you don't have a contract with them. This is a returning revenue. And then you have revenue where you have to go, have a sales crew, they have to sell all the time. That actually has the lowest value, unfortunately. Growth potential. Does your company have growth potential, or is it a company that is already, how do you say it, saturated and does not have, but there is always a growth potential if you looking a little bit deeper into it. Customer score over the last years, which is a really important part. Everybody should know, okay, are you a reputable company, or do you have bad services, or really good services? That's what we also look at. And then hub and spoke, which is a really important part. This is how involved is the business owner in the business. Are you working in the business on a day-to-day basis, or are you working on the business? That is important to a business owner or any buyer who wants to come in. For example, if you are leaving and you take all clients, or clients come back anymore, that'll be a big risk for a business a buyer, and they don't want to take on the risk. So that needs to be looked at, and it's always a very important aspect. So these are the 8 drivers. So how do we actually come up? We actually send out, or we're working with a 35 questions that covers all these 8 value drivers, and it's a multiple choice questionnaire. It's very easy to handle, and if you like, and we will actually send out an email after we're on together with the recording. You can, if you want, do these questionnaire. It's for free, and I will send you a report that looks like this. It has much more in it. and explains why do you have this and what you can do on the high level. So look at these financial performance. You know, it looked always like an industry average and how this company scores here. 67. So in this case, for example, the hierarchy of recurring revenue, they don't have any recurring revenue, so which is score 0. It brings the overall score down. And then you see also what I mentioned before, the hub and spoke, it also brings it down. So what is, why is this important? You see the red area, the yellow, and the green. And in this case, there is an overall score of 60. And 60 is, if you look at the next graph, the estimate of value. If we look at 60, we are in the middle of the bell curve, and that actually reflects directly to a multiple, what you see down here, of about 3.25. So if you do the math here, we look at the 630,000 EBITDA times 3.25, we're gonna have a mean value of about 2 million of the business. So if you look at this one here, that's where we're supposed to be, 80% and more. We call it as best in class. You will have a multiple all of a sudden of 5.27, which will reflect into a 3.3 million. It's about 1.3 million more than when we would have been here, because the risk for any buyer, doesn't matter if it's financial buyer, strategic buyer, or private equity group, is much, much lower than if they would have bought or would they want to buy this one here. So this is the reason why we do a risk analysis on this level, and we can work on how do we mitigate the risk, or how do we actually increase value. So here is, again, this is the calculation, 360 times 3.25, because it's a valuable score of 60, we end up at $2,047,500. So what can we do? When you work with your financial planner, and that's what I mentioned in the beginning, he, based on your personal goals and based on what you would like to do in the future, he calculates and said, you need $5 million in this case. I mean, I made it up, it's not, but that's kind of to get the concept, to keep the lifestyle in everything what you want to do. So you have already invested 1.5 million, let's say current assets, stocks, real estate, whatsoever, which has a value of 1.5. And then you look at the business, you put it on top of it, we add 2 million and almost 2 million, a little bit more. And you see there's a value gap of 1.45 million that you still need to keep your lifestyle afloat over the years. So what are you gonna do? And that's why the Excel planning is very, very important to every business owner, because you cannot work on those here, but you can still work on the business value, right? So going back into these 8 drivers, so we could actually work on just, not on all of them, but let's say on 3 items over a year, looking at the low-hanging fruits and say, what can we do to actually work on the hierarchy of recurring revenue? We don't have to move it all the way up to the green, but we can still have it at, let's see, industry average. We could still work here on the hub and spoke. How is your owner's involvement to bring it up to the green level here in, let's say, implementing processes, writing down processes so that someone who comes in can read about it and knows how to do certain things. Or you would delegate tasks that what you are doing right now to someone else. And then we also look at the financial performance. And these 8 drivers and these 8 ideas, it's just ideas, but it has to be looked at. And we at Best Exit, we're not giving you, okay, you have to increase everything to green. We actually, with every single driver, we give you ideas and work with business owners how to do it. And that shows you the next slide here. For example, just increase the financial performance of your business. We look at let's say, revisit the price calculation at least once a year and see if your price is calculated correctly so that you make enough a profit at the end. We look at important financial ratios. There are many of them, but you don't need to look at everything. The importance are cash flow to revenue, cash to revenue, inventory to revenue. How many times do you turn over revenue or inventory? And then also receivables conversion. That means how long does it take to get paid, right? And there are very interesting measurements that you can put into place to reduce payment terms. Customer evaluation. I do that all the time with my clients. We look at every single customer and say, okay, is it profitable or is it not profitable? It's a very interesting exercise. We have 4 different criteria. We look at, is it a customer, for example, who is very profitable? And is it a customer who pays always on time? Is it a customer who is really hard to deal with? Et cetera, et cetera. And then we look at those and see what we can do here. Clean up financials and prepare for next. Minimize non-operational expense. For example, what I mentioned before, if you pay for your daughter all the telephone, or you have a lot of old-timers, for example, in the garage, you want to actually take those off and pay it out of your personal account, not through the company anymore, because that's not a good sign. Industry account structure, chart of accounts. What I've seen in many income or P&Ls, there are expenses that are in the expense area that actually belong into the cost of goods. So to make it comparable to other companies and other things too. So create usable KPIs, key performance indicators. Where the customer, we develop KPIs, revenue per customer, profit margin, net promoter scores, and many more. And he gets it every day on his cell phone, and he knows exactly what's going on in the company. How long does it take to collect AR, for example. And a very important part is create a forecast and monitor it. Plan versus actual. Do it monthly for 1 year, and then also yearly for, let's say, 3 to 5 years is not really important, but 3 years would be really great. So you can see what you plan and what is actually has been accomplished or achieved, so that you can adjust all the time. And you can do it in so many different areas with certain products, revenue, how many customers you get, how many customers you lose, and many different areas. But that gives you a grip on your company, so that you know what's going on and know how you can grow it. So once you get all that, we can actually, with these 3 items, we can actually not increase EBITDA in this case. Most of the time it will increase, but we increase, as I mentioned before, the multiple, 5.27, and we are adding 1.3 million always, only to the value of the company. And all of a sudden, what you see here, we eliminated the value gap and putting it on the market, having not so much risk, increases the probability you can sell the business to a premium price is much higher than before. So this is the whole idea behind looking at the valuation, looking at the quality or the risk analysis, and show how you can actually decrease the risk for a buyer to buy your business. At the conclusion, the benefits of exit planning is you can retire happily. Look at these couple at the little motorcycle. You can improve business value. In some cases, if you don't want to exit, you know what happened in your business, but you can sometimes buy another business to bring it up to a next level. As I mentioned before, size matters, revenue matters. If you are, let's say, a $5 million business and you buy another $10 million business, let's say, you all of a sudden coming into a range where private equity groups are much more interested in acquiring your business than it was when you just said $5 million business, let's say. So you pay less taxes. You really need to plan ahead to reduce the tax bill when you exit a business or when you transfer the business. Improve profits is less stressful because you take yourself out of the business. And then also, yeah, you don't have a regret after you exit the business. Many business owners, they regret after the business owners, after they exit the business, which is not good. Of course, the family and other stakeholders are happy. You protect your family wealth. And this is an important part. Protect family wealth in the case of an unexpected event like death or disability or some health issues. Let's say all of a sudden something happened. If you have planned and worked on the business, there is no timing issue where you can say, oh, I need to do this, I need to do that before I can sell or put it on the market. But then you have an issue that because you have health issues, what I've seen in the past. So in this case, if you're prepared, it doesn't matter when you sell it, you're always prepared. And that's actually the beauty in exit planning. And of course, you have an improved personal wellness. So this is my presentation. I hope I was not too long. So if you have any questions, let me see if there are any questions that actually came in here. Let me see. Oh, okay, I have two one question I'm going to answer here. So you talked about the Value Builder score quite a bit. What exactly is it? And can you explain a bit more about how it works? Will it help me to figure out what my company is worth? Yes. So Value Builder score puts many different aspects into the account. So the way you actually answer all these questions, it will give you a score. It's like a credit score, what we have. And I put it back here. It's kind of a credit score, what you have. And it will give you a range what the business is worth. But not only that, it gives you also an idea what you can do to improve the value of your business. So that is an important part, the way you can start with. So sometimes you don't know where to start. Is it my revenue? Is it my customers? My processes? How I am involved, etc., etc. With the Value Builder score, we can identify exactly what area you can start working on and have milestones and goals set that actually fits your pace and your unique company that you're working on. Another question. this question may be not directly related to selling a business, but how do you become an exit planner? Oh, yeah. Yeah, thanks for that question. I'd be happy to answer or talk about that. So you can actually use my address, phone number, and email, and we can talk about that offsite. Because I am actually actively looking for agents or exit planning consultants I can work with, because there are a lot of companies and business owners that are asking for valuations and how to actually start to work on their business. Another question I have is, you have talked about multiples of 4 and 5. I have heard of higher multiples of 10 or more. Is that something that is realistic? Yes and no. Yes, companies sometimes they have a multiple of 7 or 10 or even higher. I have to say this more like reflects to or relates to companies that are much bigger, because another big company wants to buy another big company to gain market share. And that is something on a national basis most of the time. And there's another aspect to that. I just recently talked to a business owner, and I came up with a valuation, and I came up with, okay, you have a multiple of 6. And he said, oh, I should actually heard that my business has a multiple of 7 or 8. And I said, yes, I use adjusted EBITDA, which is higher, and they used an unadjusted EBITDA, which is lower, and then you have a higher multiple. So the outcome is kind of in the same ballpark, but you really have to be careful. The bigger the company is, the bigger the multiple. The smaller the company is, the smaller the multiple, but not only the multiple. And so you have to be careful in just looking at multiples. There's much more to it. Okay, so thank you for staying with me. I think we actually covered everything. We went below an hour, and as I mentioned, we have recorded the webinar. We will send you the recording. I will also send you a link to the Value Builder score. It's for free. You can actually log in, go through all the questions, and I will send you the complete report. It's about 35 pages that gives you a deeper understanding why you score 56 or 84 or whatsoever, and also gives you high-level ideas what you can do. If you want to dive more into that, we can discuss what we can do. And as I mentioned before, with the financial performance increase, there are many different tools and ways to really increase the value or the scoring of the business in each of the 8 scores. We will also send you a link for a download. You can actually exit or download an exit checklist ebook that highlights everything what you have learned today, and give you sometimes what you can actually look at it, back to it, and use those insights to develop an exit plan with your financial planner, or you can talk to another certified exit planning advisor, or you can also talk to me. It's up to you what you want to do. So, yeah. And then if you have any more questions, please feel free to send me an email, or you can also call me. Yeah, thank you very much again for your participation. And I hope that it helped you to get an idea about exit planning. And yeah, I wish you a wonderful rest of the Thursday today, and enjoy and hopefully see you soon. Thank you. Bye-bye.